let's consider the financial or capital acquisition and investment decisions that the firm makes. The financial capital of the firm consists of bonds, preferred stock, common equity. So this is the sources of capital. It's the financial capital of the firm. And the money that we raise through the sale of these securities, bonds and stocks, the money that we retain in earnings, in retained earnings, is going to be invested in what we'll refer to as the real capital of the firm, the long-term productive assets, plant and equipment that we use to earn the cash flows that we can then distribute to our various shareholders and security holders, bondholders and shareholders. We want to minimize that cost of equity, that overall cost of capital actually, but to minimize the cost of equity, we might sell stock when the stock price is fairly high. Likewise, when interest rates are low, we might issue more debt. But we always want to be balancing this debt and equity in order to find sort of the sweet spot where there's a minimum cost of capital. Now, firms actually have some leeway, and the absolute sweet spot isn't knowable. So instead, firms will normally say, well, we want to keep our cost of capital or our debt to asset ratios between some reasonable values, say X and Y. And maybe X here is 40% debt and Y is 60%. And in between, we don't know exactly where the minimum is, but we're going to be reasonably close in terms of minimizing our average cost of capital if we keep our debt equity mix in this range. Now, at different times, the total cost of capital might differ. So we look at time t here. The weighted average cost of capital at time t might look like this curve right here. Okay. Having said that, we're going to want to, at that time, try to keep our debt equity mix somewhere in a range that lies between this X and Y point. It's possible that overall required returns will fall, that interest rates will fall. An example might be at the end of the Cold War, there was a general belief that the world had suddenly gotten safer. The Soviet Union and the United States weren't going to engage in a nuclear war. Everything was safer. Therefore, required returns dropped. Stock prices rose. Interest rates could fall. And so you were at a new point in time. So overall, for any given debt equity mix, you were going to have a lower cost of capital. But still, given that point in time, you'd want to be between those 2 points. So the overall cost of capital might change. In fact, it might go down some more to this point right here. The overall cost of capital might change, but that sweet spot area is likely to be somewhat durable over time. The required rate of return that we have for individual projects is going to be our weighted average cost of capital. Even if we are going to choose to borrow a little more money currently, we know that's going to drive the cost of our equity capital up as well. So we need to evaluate projects on the basis of the weighted average cost of capital. The value of our stock should rise, or at least stay the same, as long as the firm is earning on its projects, on its real capital investments, a return that's equal to the weighted average cost of capital of the firm. If it doesn't, the bondholders get paid first, the shareholders last. The shareholders are the ones who suffer the consequences if management makes bad investment decisions. At least they suffer the major consequences. Let's consider a Baker Corporation that has multiple projects. Here we have 8 projects, A through H, and the expected returns that they have along with the cost. The costs are along the right-hand side, and we've ranked them by expected returns. Baker's weighted average cost of capital is 10.41%. that means that if it takes projects A through E in blue, if it takes any of these projects in blue, it will earn a return greater than its cost of capital. But when it drops down to project F, if it takes this project on, the cost of capital is 10.41%. Taking on that project will actually reduce the value of the firm. It should have that project will have a negative net present value. So we're going to want to reject that particular project, as well as projects G and H. We can look at this graphically as follows. We see along the bottom the total amount of capital. We have as much as $95 million to invest. And for all the projects that have an expected return above this weighted average cost of capital line, we're going to want to invest in those. But the projects that have less than that, we're going to want to avoid. Now, having said that, this assumes that our weighted average cost of capital is at the optimum. If, in fact, we're not where we want to be in terms of the debt equity mix of the firm, and we can make alterations that will reduce our overall cost of capital, it's possible we could push our cost of capital down to a lower level. If that were the case, if we're able to change the way we're raising capital, we might find that there are other projects that we could then undertake in a profitable manner. But until we can do that, until we can find a way to push down the weighted average cost of capital, we're going to be limited to projects A through E. And a great deal of what managers spend their time on, they actually spend more time worrying about selecting projects A through E than they do worrying about how to push that down. As a general rule, there's certainly some time spent in estimating weighted average cost of capital, but the big question is, are we making the right investments given the nature of what capital is available at any given point in time? Keep in mind that the economy may change and overall required returns may change. If that happens, and this will make sense, I hope, if the required returns in the economy change, the cost of capital goes down and firms make more investments. If, having said that, the economy turns sour, there's a panic, there are new risks that appear in the economy, and the cost of capital goes up, it's a rational, in fact a prudent decision for companies to decide, I'm not going to take that particular project that I previously thought I would. It no longer makes sense given the new realities in the market that the cost of capital has gone up. So in some cases, for example, a financial panic that causes the cost of capital to rise will also cause companies to change what they invest in, and the financial panic will spill over into companies making fewer investments in the real economy. And when they do that, a recession is likely to occur.